Samvat 2080. We're also given to understand Nilesh Shah, Managing Director, Kotak Mahindra, is joining us on the show at this point. But before we get to that, let's quickly bring our viewers up to date on what's happened so far. After a record-breaking run in equities, Samvat 2079, the year, as I said, as per Hindu calendar, will be ending this week, and Samvat 2080 will kick off. Samvat 2079 has been a very interesting year for the Indian equity markets, characterized by notable volatility in the first half as a result of a hawkish central bank view on interest rates, rising bond yields, Russia-Ukraine war and surging crude oil prices, as well as sticky inflation. The second half of Indian markets witnessed a remarkable recovery from its March 2023 bottom, with volatility being the flavor of the year. Samvat 2018 will be interesting to watch out for. Without further ado, let's get in Nilesh Shah into this conversation. Nilesh, thank you very much for taking time out, sir. Thank you for speaking to News9. What are your big expectations of Samvat 2080?
Thank you, Shweta, for having me over here, and wish all the viewers of Newsline a very happy Deepavali. If you see, last year we had series of events which should have shaken the confidence of the market. But if we see at the end of the year, with the benefit of hindsight, market has overcome all the hurdles. Deficient monsoon, higher for longer interest rates, geopolitical tension, and this is primarily driven by one, India becoming the fastest major growing economy, and corporate India showing remarkable profitability growth. I think in the Indian market, there is convergence of 3G, growth better than peer group, governance better than peer group comparable to developed world, and green transformation, India being the lowest per capita carbon emitter in the world. As long as we deliver on these 3Gs of growth, governance, and green, I think markets will continue to reward investors.
All right, growth, governance and green, gentlemen. That's the word coming in.
Yeah, so I think Mr. Nilesh Shah, thank you so much. In fact, it's wonderful to have you here with us on this weekend edition, and this is the Diwali weekend. But growth and green are sentiments which are very well reflected in the markets as well. Governance also, of course, I think, like you mentioned, is something which is India's sort of calling card right now. But specifically coming to investors, Mr. Shah, I think everybody looks up at Mr. Nilesh Shah to understand what should the investment strategy be, not just, at Samvat 28, but even any time of the year, but specifically right now. We are seeing the closure of Samvat 79, the onslaught of Samvat 80. So for a retail investor, are the markets too hot, too volatile to touch directly? And do you suggest mutual funds should continue to be the way ahead?
So never ask a barber whether you need haircut or not.
I can never do that, sir. I don't go to a barber, but...
Never ask the fund manager or a CEO whether you need mutual fund or not. But frankly speaking, on a serious note, anyone who doesn't have time and inclination and knowledge should come via mutual fund. I'll give you a very simple example. We run a multi-asset allocation fund, which divides between debt, equity, and now gold and silver. Over 17 years, it would have grown about 16 times. In my opinion, 99% of investors would have underperformed that fund. So it does make sense for investors to come via mutual fund if they don't have time, knowledge, or inclination. To retail investors, at this point of time, stock market is like a choraha. On the large cap stock, there is a green signal. Valuations are in your favor. They haven't delivered much over the last 2 years. And now the future performance should be better than the last 2 years. The small cap, micro cap, mini cap, SME exchange is a red signal. Valuations are ahead of large cap. There are many companies where floating stock is limited and hence prices and valuations are way above historical average. Collectively, small cap trades at 21% premium to its historical average. It's a red signal. Mid caps are somewhere in the amber signal. They are trading at about 6% premium to their historical average. So my recommendation to investors, be equal weight to equity as an asset class. Within that, be marginally overweight large cap, equal weight mid cap, and underweight small cap, micro cap, mini cap, and SME exchange.
But so many, market watchers right now seem to be of the opinion that the small cap rally is actually going to continue for another 5 years or so, despite the valuations being high, like you just mentioned. But for a retail investor, you're saying small caps are a red signal, and hence we should go ahead with the traditional large cap blue chip and a little mix of mid caps and a small segment of small caps. Does that sort of contradict what the signals have been on the growth of small caps up until now?
So if you are taking a 5-year horizon and you are willing to suffer volatility in between, then yes, small caps should do better than large cap. But frankly speaking, how many investors have that kind of view? Most of the viewers, when they ask us question, they are asking somewhat to somewhat.
Yeah,
And we have to remind that in equity, you don't come somewhat to somewhat. You come somewhat 2080 to somewhat 2085 or 86,
right,
not 2081.
right.
So depending upon your ability to withstand volatility, if you are doing asset allocation in small cap, that's fine. But because small caps delivered last year 30% return, hence I should put money in small cap, then it is better to be cautious.
Right. Okay, we'll leave mid caps and small caps alone for a bit, Mr. Shah. There's also the rates of spot gold and spot silver. They say when there is so much volatility in all asset classes, the logical option is definitely, gold and silver. Those numbers are up. So if I were to ask you again as a retail investor, what is the percentage of gold that should be there in my portfolio? Usually it's 10% is what they say. Should I increase it considering the amount of volatility around?
So we have optimistic view on gold because central banks around the world have been buying gold. They are behaving like our, housewives who have been buying gold forever. And gold price will get supported in the days to come as US interest rates come down. But when you're investing in gold, you need to remember few things. One, there is 18% tax incidence in India. This is encouraging gold smuggling, and someday government will lower those tax incidences. If tax incidences theoretically becomes from 18% to zero, you will lose 18% of today's market value. So please be aware that you are buying gold at 18% higher than what you will get in international market. Second, today is Dhanteras. Many people will go and buy small denomination gold, 1 gram, 5 gram, 10 gram. When you buy gold in smaller denomination, you pay very, very high premium, 25%, 30%. Now, 18% tax and 30% premium, you are almost losing half of your investment at the time of investment. So be very, very careful. Third, if you are investing for longer term, sovereign gold bonds are the most appropriate option. You get 2.5% coupon. You don't have to worry about quality of gold. You don't have to worry about safekeeping. So first preference, sovereign gold bond, keeping in mind that there is 18% tax incidence.
But so sovereign gold bonds again become long-term instruments. Do you think gold ETF then might also be an instrument worth considering? Because sovereign gold bonds, to get that 2.5% interest year on year, and thereby the locking in period of between 5 to 8 years comes in. Would gold ETF be something that you would suggest people who do want to make investments in gold as a route to take?
Undoubtedly, if your time horizon is small, you are investing with 1 year, 2 year, 3 year perspective, then gold ETF is better. The entry premium for gold ETFs will be maybe at best 0.5% to 1%. And gold ETF as well as gold fund of fund are both available. If you have Demat account, you can buy gold ETF from market. If not, then you can buy gold fund of fund, which invests into gold ETF. So for Demat as well as non-Demat account holder, there is a much, much cheaper way of buying gold than small denomination gold in physical quantity.
All right. And if we were to move away from gold, sir, there were these talks at some point about looking for this Goldilocks sort of an environment where the markets are not too hot, not too cold, just right. I know it is difficult for anybody to time the market, but in your personal opinion, overall, when you talk about the equity markets, we've seen that even though the volatility has been on a day-to-day basis, up 1%, down 0.5%, overall what is happening across the world has not really had a major impact on the Indian equity markets yet. Going forward, if the war in the Middle East continues, Russia-Ukraine war, we know what's happening, overall pressure on oil, where do you really see the markets headed from here?
So, in the last 1 year, we have seen many concerns coming to disrupt market. The latest one was oil. And our worry about geopolitical situation in Middle East is more related to supply of oil and price of oil.
That's right.
Today, oil prices were threatening to go to triple digit because oil cartel lowered the supply by about 4 million barrel between Saudi-led OPEC and Russia-led non-OPEC.
That's right.
Fortunately, US got some wisdom and they proposed relaxation of sanctions on Venezuela. Venezuela has more oil reserve than Saudi, but their oil production is just 750,000 barrels. Now, Saudi also knows that 15, 20 years down the line, what will be left with them in terms of oil will be useless because of global warming and shift to alternate fuel.
The energy
They would
transition.
like Venezuelan oil to flood the market, so increase the production and lower the prices.
Right.
There is a divine intervention, let's say, which has brought down oil prices and supported the market. We saw same thing with monsoon. It was double-digit deficient in August, but September rains recovered and it became mid-single-digit deficiency. On the US interest rates, there was worry that it will remain higher for longer. But fortunately for India, the corporate India is deleveraged, household India is deleveraged, and hence we are not seeing material impact of rising US interest rates. So
Right.
as long as our economy does well, we deliver on earnings growth, we deliver on governance and respect for capital from global investors, and we continue to pursue the path of green transformation for our economy, I think markets will continue to reward investors. Will there be ups and downs? Undoubtedly. But if you are taking a longer term view, it's no better bet than India.
Right. Mr. Shah, there's also been a lot of conversation around volatility in crude prices. As you mentioned, there was a divine intervention, touching almost $100 a barrel, coming down to 80 all of a sudden within a span of 2 months. This volatility is concerning to India as well. As a net importer of oil, anywhere between 80 to 85 augurs well for India, but anywhere above 95 consistently does not. Nobody can really predict where the prices will go in the next couple of months. What are you making of this volatility, sir? Are you of the view that this volatility will now be tamed? We have seen the worst from what could come out of the Middle Eastern war, or there would be further volatility that one has to brace for?
So, Shweta, it's always difficult to predict in the short term what can happen. And especially when geopolitical events are driven by emotions and not by rationality. How do you predict emotions? People will take illogical decisions. But to me, India's economy has grown. In 2008, when oil touched 100, we were 1/3 of Brazil and Russian GDP put together. My ability to bear higher pain of higher oil prices was much lower. Today, we are almost equal to Brazil and Russian GDP put together. My ability to bear higher prices of oil is far, far better. Second thing is the focus on renewable energy. Today, 21% of our power is produced through renewable energy. We are focusing on solar energy, we are focusing on nuclear energy, and there is also some focus on wind energy. My feeling is that over a period of time, we should be able to reduce oil intensity of our economy, and hence our ability to bear higher prices of oil will increase. Do remember that if oil continues to remain below the ground for oil producing countries, over 2-3 decades, it will be worthless because world would have migrated to non-fossil fuel sources.
All right, and that would be a good news. But before we let you go, I know we have to let you go. I think any investor watching this show would want to know from you, as we commence Samvat 2080, give us quick 3 to 5 tips something that investors can count on at their fingertips. What should they keep in mind before investing this new season?
One, please stay away from all those small cap, micro cap, mini cap stocks where valuations are high because floating stock is very, very limited. In those pockets, you are unlikely to make money despite solid last 6 months or 12 months return. Second, don't invest with one Samvat to another Samvat in mind. Invest with a view that today Indian economy is $3.5 trillion. Over a period of time, it has potential to grow multiple times from current level. So don't invest from one Samvat to another Samvat. Invest for the Amrit Kal of India. Third, invest on a regular basis. Little drops of water will make ocean. Your regular investment on a monthly basis in equities or equity mutual funds over a period of time will create your financial security. And finally, please be a disciplined investor. Diversify yourself across debt, equity, real estate, and precious metal like gold and silver. Markets will be volatile, they'll go up and down. But if you are diversified and generating real return, that is return more than the inflation, your financial security will be achieved.
All right, wonderful. Thank you so much for those words of wisdom, Nilesh Shah. Thank you for having us or joining us and for having us in your journey of Samvat 2080. We hope to get you back next season, next year. Thank you so much.
Thank you and wish all the viewers a very happy Deepavali.
To you too, sir.